Welcome back, folks. Again, we're talking about commodity trading, and it's important that I remind you to read the disclaimers here. And I am not a commodity trade advisor. I'm not licensed to give trade advice. Everything that's mentioned in these topics referring to commodities are specifically to be viewed as paper trades only. Okay, folks, the June 2017 ICT Mentorship, ICT Commodity Trading Lesson 4, Premium versus Carrying Charge Markets. And this is going to provide you an X-ray view of institutional order flow. Okay, when we look at commodities, one of the best resources you have at your fingertips and for free is on barchart.com. And this is what you'll see generally when you click on a commodity, and it'll pull up the contract delivery months that it's available. And we find that by going to the select commodity tab over here, and you just scroll down and you find whatever commodity you want to do your analysis on. One of the things you want to do periodically as a commodity trader is once every 2 to 3 weeks, you want to be looking for markets that are developing a premium. Okay, it used to be when I first started as a trader, commodities would be listed in the newspaper like Wall Street Journal and Investors Business Daily. Not that they're not listed now, but that's where I would usually scan. I would look for a premium or a lack of premium in the delivery months. And we're looking at cotton here. And you can see that all the months that are available for trading for this particular commodity are listed on Barchart's website. Classically, what you'll see when we pull up, for instance, soybeans, and we're going to assume that the column that shows last here, that's going to represent the closing price. Now, obviously, at the time of this recording, I was getting prices, and they may not be representative of closing prices, so just for disclosure's sake. But we're going to assume for a moment that we were looking at the market after they close, and we look at the closing price, or in this case, the last. And generally, if there's a cash market that could be seen for a commodity, they'll list it first on barchart.com, and that'll be at the top of the list. And then immediately below that, you'll see the first contract delivery month, or what is referred to as the nearby contract. The immediate contract month right after the nearby is always referred to as the next month out. So we want to be looking at the nearby and the next month out always, okay, in contrast to whether there is a premium. When there is no premium, we have what is referred to as a carrying charge market. Now, a carrying charge market is simply today's price viewed in the nearby contract. If today's price is $9.40 on the July contract of 2017 soybeans, we could see in August, the next month out, there should be an increase in that premium or closing price, and we see it here. So in July 2017 soybeans, closing price would be representative of $9.40, and in August, its closing price would be representative of $9.43 and 4/10. So we're seeing an increase. And then the next month out, further out in November, we can see that the closing price is $9.45. And in January of 2018, it's $9.52. So this is a typical carrying charge market. Nothing fancy about it. Doesn't mean that we can't find bull markets in an environment like this. It just means that the likelihood of a parabolic move or a rapid increase, aggressive repricing of the commodity is far less likely to occur than that of if it had a premium. Now, looking at a market that has a premium in it, we're looking at feeder cattle here. Again, barchart.com, we can see the cash market listed first, and the nearby contract at the time of this presentation is August 2017's feeder cattle. And its closing price, if it were closing prices, would be $154.80. And the next month out would be September 2017 feeder cattle with its price of $154.125. So the nearby contract is selling at a higher price, not much, but it's selling at a higher price. So therefore, we're at a premium. Now, the way you look for whether there's a strong premium or a really significant premium is you want to go out to the next month beyond the next month out. So in other words, you want to look at the next few months. So for August, yes, there's a premium based on the price that's seen in September. But in October, we have it cheaper even still at 152.775. And then in November, we have even lower prices at 151.275, and then it drops off in January down to the 145s. So there is a premium in the feeder cattle markets. Now, what does this imply? It means that there is something fundamentally strong about that particular commodity. In other words, the demand is high and the supply is short. Okay, so you've never really heard me talk about supply and demand because I think that way of trading, especially as it relates to Forex, isn't the real thing you should be doing. But there are real supply and demand factors with commodities because they're real tangible things and people need to eat. So like I said, if you like cheeseburgers, and steaks, you're getting it from feeder cattle. So we're seeing a clear, obvious premium, and that's seen by today's price being higher than that of the next month out and the future months in the future. So if the price today's nearby contract is higher than the contract delivery months that are after it in terms of the calendar going forward, that is a premium market. This promotes the idea of what is referred to as a commercial bull market. That means that the commercials, large dominant users of this commodity, will be looking to take delivery of it right now immediately because they have to have it and it's a short supply of it. So if they're willing to pay a premium price for it now versus what would be expected as a carrying charge premium later on in delivery months, they know that there's something fundamentally going on that they have to get the delivery of this commodity right now. So that's what causes these premiums to build up. Another example here is seen in live cattle. You can see the cash market at the top. The delivery month for the nearby is June. Its closing price would be representative of 131.20. And then the next month out is August at 124.175. And then in October, we can see 120.40. So again, there's a premium in the nearby month. Next out months are selling at a lower price. So there's a premium here implying that there is a short supply, and the traders or those that are looking or seeking delivery of the actual commodity, the actual cattle themselves, the interest is so strong that they have to be paying a premium now for it because, again, the supply is short, but the demand is exceedingly high. Okay, so let's take a look at a case study, and this is going to be done on the cotton market. And again, as I open up this teaching, this is all the delivery months for cotton. And knowing now what you're supposed to be looking for, and it's very simple, I want to ask you a simple question. Does the cotton market show us a carrying charge market, or does it show a premium market? Again, we start by referencing the nearby contract versus the next month out. There's a premium here. Okay, so cotton is selling at a premium. So now we have the conditions that are ripe for a commercial bull market. Now, what is a commercial bull market? A bull market is classically seen with higher highs and higher lows and price increasing over time, obviously. But there's two different kinds of bull markets. One that goes up gradually, stair-stepping, higher and higher and higher. And then there's another type of bull market that goes parabolic and vertical. And it does it quickly, and the amount of speed and magnitude the move takes place is usually a signature and hallmark of a premium-based rally. So usually the commodities that have a premium built in, like we're discussing here, they have a tendency to move really quick in a lot of distance in a short amount of time. Okay, so we're looking at here, this is the daily chart of the nearby contract for cotton. We're represented by the July contract. And I want you to take a look at price. Obviously, when we look at commodities, nothing is different in terms of how I look at price action. Everything is based on PD arrays, premium, discount. Now, when I say premium, when it refers to commodities, it's the specific pricing of the nearby to the next month out. If the nearby contract is selling at a higher price than the next month out, that is a premium. Do not confuse that with premium and discount PD arrays. Okay, in other words, the PD array matrix. Don't get confused by that. But in this particular commodity case study, we're going to look at the implementation of the things that I've already taught you, and now using it with gauging whether there's institutional buying with a premium market. Okay, so now what we want to do is once we load up our nearby contract, we want to develop a spread chart. Okay, and a spread chart is the difference plotted between a nearby contract and the next month out. You do that by going to barchart.com and you click on the little tab in the lower right hand corner here to start the spread chart. And I'm going to do a real quick overview of it. Once you load your chart up, you go over to the chart type, click to spread chart. Okay, and you want to go over to where it says first symbol. You want to click on that, drop down into your commodity of choice, and we're looking at cotton now. So we're going to go to the cotton market tab, click on it. Then we're going to use the nearby contract delivery month, and that is July. And that's trading in the year 2017. And then we're going to go over to the second symbol. We're going to be doing a spread between the nearby to the next month out. So again, you use cotton, and the next month out is going to be October. And again, trading in 2017. And this is real important. Next thing you want to do is click on this little tab here and make sure it's to the minus symbol, because that's going to give you the difference between the nearby and the next month out. And just scroll down here a little bit, click on the draw, and now voila, we have the cotton spread chart between the July and October months. The outcome is what you see here, and the significance of this is the zero line. Okay, so anything above the zero line represents the amount of spread that the nearby contract is trading above the next month out. Ideally, the larger the spread, the stronger the likelihood of a commercial bull market or a parabolic move. I want you to take a look at that spike up we saw in May. We're going to do a little bit of analysis there. But at that high in May, at its peak, the July contract was trading at 6.50 premium higher than the October delivery contract. So in other words, for July cotton, it was 6.50 higher than the October delivery contract for cotton. Now this is an overlay, and I had to create this with the software package that I create my videos with, but I did it so that way you can see graphically what it is you're using the spread chart for. So when we look at price and we are expecting higher prices, why would we expect higher prices? Well, cotton has been going higher and went into a consolidation. From January this year, it went higher. Then from March, April, May, it was in consolidation, but it had a premium. We also saw price trade down into a bullish order block in the first half of May. But I want you to look at the successive lower lows in that May decline. We made lower lows each candle, each day, but look at the spread line. The spread line was actually increasing, or in this case, diverging bullishly. Now, it kind of looks like an indicator, doesn't it? And it is, because it's price. Remember, price will tell you everything about price. We don't need to crunch any numbers, and you don't have to do any kind of acrobatic mathematics. It's simply an overlay of the spread of the nearby to the next month out. So what we do is we want to look for bullish divergence between price action of the nearby contract and the spread. So yes, it's going to take a little bit of work on your part to be looking for these things and studying them. Do you need an overlay like this? No. But I did it so that way everyone could see it easily without any miscommunication at all. You can see clearly the spread chart and the nearby July contract for cotton being overlaid with one another. You can see the divergence of the spread. Now, what's the significance of that? That's a buy signal. Going back to our July contract of cotton, we understand that institutional order flow is going to see bullishness when we trade down into a previous down close candle that saw price move away from it. That's seen here as your typical bullish order block. It's also trading down into the April high to April low range into a discount. So the PD array matrix for that range, we're in the discount range. We're at a bullish order block in a market, cotton showing a premium, July trading at a higher price than that of the next month out, October. So we see lower lows in price action as we trade into the bullish order block. But we saw the spread diverging bullishly. That is only being shown when institutions are stepping in and buying a lot of it quickly, massively. So if you ever see that when a market has a premium and its underlying bullishness and it's in a discount and we trade down into a discount array like a bullish order block or closes in a void or fair value gap, or if we trade below an old low, in this case we had that being seen with the last 2 trading days of April. We traded below those equal lows that's seen in April around that 77.80 level, and price trades down into the bullish order block. So we have a run on sell stops, we have a run into a bullish order block, and we have a what would otherwise be, I'm sure if we put a Fibonacci on it, would be optimal trade entry long at the 79 subtraction level. I didn't do it, but just by my eye, I can see that's most likely what's happening. So we're seeing a spread divergence. This is a bullish spread divergence between a nearby next month out. And when we see these indications in price, it gives us strong willingness to support the idea of being a buyer. So we could be a buyer at 77 and it moved all the way up to 87. That's 10-cent move. 1 cent move is $500 in cotton. That's a $5,000 move in the course of less than a week. Less than 1 week, one contract in cotton pays out over $5,000. Now, obviously, we have the benefit of hindsight here. And obviously, you all know that I have not been trading commodities for a long, long time. I've been primarily a Forex trader. But these things are there every year. Every single year, these are the hallmarks to what makes commodity trading fun, in my opinion. If we can spend time looking at the, dare I say it, fundamentals of a commodity market, we can get to a really strong bias for when we want to be a buyer. Now, this repeats itself in an opposite framework when there is a premium in the marketplace. If the market makes a higher high, say for instance if cotton trades up to say 90 cents, goes higher than 87 high we're noting here, but it does so with a lower peak in the spread, that does not promote or significantly confirm institutional buying. You have to take that with a grain of salt, because just like anything else, the spread, you want to see that increase with the advancement in price. So if it's strong in terms of its premium driven rally, that spread should be increasing as price rallies up. So if we see a divergence bearishly where the spread fails to make a higher high with a higher high in price, that would be an indication that we would have to look for reasons to trail our stop loss, or maybe even take some profits and wait for a new buy signal as outlined here. So now you've been armed with a wonderful smart money tool, and this works in all the commodities. And if you look at it from a fundamental standpoint, you'll always be trading with the fundamentals if you're using a premium-based idea like we're describing here. So if you ever had a doubt whether or not the fundamentals are needed, in my opinion, they are for commodities, because they are tangible, real things. That's the world's grocery store. Everything that you eat or consume or need to operate, this world, okay, it's usually in our commodity markets. So now you have a way of framing institutional buying and selling and know when they're going to be doing explosive moves in the marketplace. Until next lesson, I wish you good luck and good trading.